right, this is leveraging volatility. It's my best strategy for today's market. Okay, this is brought to you by ProAct Traders. My name is Scott Barkley. I'm the founder of ProAct Traders. All right, so for me, it's using the average true range, or the ATR. It is a measure of volatility. Obviously, that's what the theme is this month, and therefore a statistically valid measurement to hit your targets in the Forex market. So there's a disclaimer. I'm not going to read it due to time, but it's there. So the ATR, or the average true range, is used to assess the current volatility of a given Forex currency pair. We watch its history over multiple time frames, and that gives us information regarding its current volatility based on historical statistical data. We use it to ascertain whether a currency pair can accomplish the target that we have predetermined for today. The higher the ATR, or the volatility, the further the pair can travel today. Advanced Forex traders also use it in swing trading and also for determining stops when there's a fundamental announcement, and also how do I move stops en route to the target, because a stop outside the ATR, or the average true range, will rarely get hit, since the pair would have to do a complete day's ATR against you. It's possible to do that, but it's not possible. Now, the ATR was created by Wilder. It was designed for all markets. He was in the stocks and commodities market, okay? But it is especially relevant in the Forex market due to it being a $5.3 trillion a day market versus a $167 billion daily market like the U.S. stock market, all right? So banks rule the Forex world. In fact, 62% of all worldwide Forex volume is handled by just 6 banks. And day in and day out, these banks create the ATR. So here's the definition from Wikipedia of what the average true range is. You can go read it, just look it up on Wikipedia. But the important thing here I want you to see here is that it is the degree of price volatility, okay? And Wilder recommended a 14-period smoothing to get it on there, all right? And this is all of the calculation. You can see that. Wow, you go, oh my gosh, I don't want to be figuring that out every day. All right, so that's there for all of you engineering types. Now, for the non-engineering types, it is this. It is the range of a day's trading is simply the high minus the low. The true range extends itself to yesterday's closing price, and if it was outside of today's range. So the true range is the largest of the most recent period's high minus the most recent period's low, or the absolute value of the most recent period's high minus the previous close, or the absolute value of the most recent period's low minus the previous close. You can see why you don't want to have to figure this out manually, all right? But on your charts, whatever charts you got, I'm sure you have an ATR to be able to put on there, okay? Now, you know, it's you have to figure out what that value is, okay? It depends on, it'll show you what this is, and you're the one who has to figure out what it happens to be, all right? So, you know, that's just an exercise you got to do. So you can add it to any chart, and traders must extrapolate the data manually. In your case, you won't see the 7, 14, 90, or 180-day periods to compare side by side, which we do, but I'll show you that later. Regardless, if you have the ATR on a day chart, you will have the ATR for today as long as you're using a 14-day period, all right? Now, so ProAct Traders created our own app to do this at a glance, and I'll show you that later. But the important thing is that the ATR is available to virtually every trader on the planet, all right? So the average true range, or the ATR, is a statistically valid piece of information for all Forex traders. And while the ATR does change every day, because it is an average, it is usually only 1 or 2 pips difference per day, all right? So the ATR officially starts every day at 5 p.m. New York time, or the New York fix, and is good for 24 hours. So if you're going to use the ATR, you need to know in your time zone where the New York fix is every single day. All right? Then why does it work? Because the big boys, those are the bankers, manipulate the market. They can't control the market, but they can manipulate it. And they also create the ATR. They know where the ATR is saying where they're going to get to every single day. All right? So we'll show you how accurate it can be and why you should be able to increase your pip capture and also add to a winning position by using it. What's that worth? Well, I think it's priceless. So the question every day is this: can this pair get to the target today based on where I currently am and what session I am in? So let's take a look. All right. Now I'm using our app here to show you, and what I'm trying to show you here is that the ATR is 123 pips. That's the 14-day average. All right. You can see that in the 90-day average it does 121, and in 180 days, that's a half a year of data, it does around 110. Right now it's doing 122. Last week it was 123, and last week it was doing 123. See, so it's very, very accurate. All right, so we start with the 5 p.m. candle. We find that right there, right there, and we measure up 123 pips, and there you went, right there. Over here, coming down, there's the 5 o'clock candle. Where did it go? Right to the 123 pip target. That's just a simple example. I'm going to show you lots of them here in just a second. All right, so you can see that the market knows right where they are. They stopped dead, and in fact, you can see they took their positions off, and they will be taking their positions off here. See that? All right. So if one of the things you want to know where the ATR is number one, you don't want to be a buyer right there, and that happens to you. Why do you want to be a buyer here if it's just on the ATR? Well, I don't know where the ATR is. It's not a piece of data that I go get. And how many times have you traded right into the ATR? They exit their trade. You get stopped out. You go, the doggone broker stopped me out again. No, most likely you hit the target. That's what happened. All right. So let's take a look at a bunch of examples here. All right. So there you go, and right there. So the following screenshots are all from live charts, all taken in the New York session. So you're going to see the ATR app superimposed onto the charts. It's there just to show you that we can validate that the ATR actually did that, okay? So here's the ATR. This one had 153 pip, okay? The 5 o'clock candle was there. Where did it go? To the pip, to the ATR. That's right. And then it bounced off it. See, they exited right there. Why did they exit? Because they know exactly where it is. Okay. So target is hit. Move your stop. Don't give it back. All right. No more trades done now until 5 o'clock when the ATR comes back. It's not statistically probable for this to put a significant movement below here when day in and day out it does 153 pips, and it did 153 pips. So you know not to trade this again today until after 5 o'clock, and then you get the new ATR, which will now be 153 pips lower if that's where you're going. All right. So here's one. Here's a small one. This Aussie Swissy. It has a 53 pip ATR. Where did it go? Went directly to the 53 pips, stopped dead, and reacted as they exited their trades. See, if you didn't know that, you would have given it all back. All right. So the target is hit. Move your stop, okay? But it comes back up and turns down again, okay? The only place it can go is back to the ATR, and that's where it went, exactly there. So that becomes 2 trades you can make in there. Wonder if that would help your trading. All right, here's a Euro Aussie, all right? 5 o'clock candle, we're going up this time, 104 pips. We measure 104 pips up, target is hit, move your stop. If you did that, you didn't give all this back. If you didn't know where it was, you're thinking it's going to go to the moon, especially when in a case like this where you've got a top here, right there, and you're thinking, I'm going to get to that top right there. But guess what? They did the ATR. That's all they did, right? Pulled back. Now they can go after 5 o'clock forward again. See that? All right. So there you go. All right, here's another one. It's the dollar CAD, 77 pips ATR. There's the 5 o'clock candle. Where did it go? To the pip. Target hit. Move your stop. And this one never pulls back and goes. It just gives it all back. If you knew that, you moved your stop, you protected your profit, and you didn't give any of that back. All right. Here's the 5 o'clock candle, 172 pip ATR in the pound yen. Big pip mover. All right. If you don't know it goes 172 pips and you go grab 10 or 12 pips, you go, wow, I'm a winner today. Yep, you're a winner. You just won the battle, but you just lost the war because you have to be 90% correct if you trade like that. And it's not possible to do that unless you are the greatest trader on the planet. So ask yourself, am I the greatest trader on the planet? If the answer is no, you got to quit it, all right? But you got to know where the targets are, all right? So here's this example, 172. They don't get to it, but I have still plenty of time in the day. So there's the pullback. Should I trade it again? Yes, it does 172 pips a day. Well, trade it again. What did it do? To the pip. You see that? Now that becomes two positions. The first one goes 172 pips. The second one goes about 60 pips. Add them together, you're over 200 pips on that trade. And by the way, that's very typical for our traders at ProAct Traders. All right. So here's another one, 219 pips from the 5 o'clock candle. There it is right there. All right. So what do? Pull back, trade it again. We didn't hit the target. Trade it to the target. What did it do? Target hit. Absolutely. See that? Wow. Crazy, right? This is all taken the same day, folks. All right. Now, here we have the, and on here like this, we open up the charts, and what do we see? Looks like a great trade. Look at all that momentum in the market. Wait a minute. There's not enough of the ATR left. I'm going to pass on it. Even though it looks absolutely perfect, they're screaming to the downside. I am not going to take a trade here because this is a high-risk trade with low reward. Your risk is above here, and your reward is right here. So there's your risk, there's your reward. I'll pass on that trade. Why? Because I know where the ATR is, so I know that I don't have enough room there. All right? So what happens? All right, gosh, that looked like a smart move. All right? I didn't make that trade, and they didn't make it either, and they gave it all back. See? Now, once you know where the ATR is, you can dramatically simplify your trading checklist, okay? What do I need? I need to find a wide open space that's 55 pips or more minimum. Why do I need to find that? Because big boys can't trade unless they got 55 pips or more. The average bank trader is trading 20,000 standard lots. He can't go into his boss and say, boss, I made 10 pips on this trade, and you risk 20,000 lots to make 10 pips? Don't let the door hit you on the way out. They have to have big spaces, right? We call them wide open spaces. I also have to have a place to press my winners without exception. It's the key to trading in the Forex is multiple trades on a winning trade, and a losing trade only has one position. And then how much of the ATR is left when I open the charts. If I open up the charts in London and I got 120 pip ATR and it's done 20 pips since Asian market, since 5 o'clock, since I got 100 pips in front of me. But I open up in the London market and the London market moved 100 pips during the night. I only got 20 left. And oh, there's a perfect trade and there's my perfect setup. There it is. It goes 20 pips and bang, you get whacked again. What happened? You didn't know where the ATR is. It's going to happen virtually every single day, folks, okay? So the number one reason that traders fail is that they let their losers run and they click their winners out too soon, all right? Why? Well, obviously fear is a factor, but most of the time, since a retail trader typically does not know where the big boys are trying to take the currency today, by the way, that's the ATR, then they can't stay in for the target. And studies have shown that unless the target is visual on the chart, a trader will bail at the first sign of a pullback. Does that sound familiar? Most traders trade for a measly 5 to 8 pips. And by the way, there are no currencies that have that low an ATR. So they must be right 90% of the time for the rest of their trading career to be profitable. It's not possible to be 90% correct for the rest of your life unless you are absolutely the greatest trader on the planet. All right. So there you go. All right, so this is our little app right here. It's got some really cool features, but one of them is to be able to see across here multiple time frames. Okay, so right here, for instance, on this, let's just use the Euro Aussie down here. It's highlighted. All right, 61 pips is what it's currently doing. By the way, that's the #1 traded currency in the world, the euro dollar, and it can only do 60 pips a day. What is that? That's only 20 pips a session. Wonder why I'm not doing well in the euro dollar. It only does 20 pips a session. All right, but in the 90-day and 180-day, it does 70 and 75. So in this instance, we would know that if our target was 70 pips away, even though we had a 61 pip ATR, we would know that the currency has an opportunity to get to them. All right, so it has the ability to do that. So you pick a pair and it highlights it. It's real easy to see. And if you check it, it stays on top of the charts and it just it's superimposed and just floats on top of your charts. All right. So we used the 14-day, all right? That's the important thing to understand. That's what we use for today, the 14-day. All right, so the ATR gives a view of the top 20 pairs and the ATR of a pair with a 7, 14, 90, and 180-day period. Why is that important? Well, we can know what a pair statistically moves day in and day out. We use it to determine the realistic target of a pair in a 24-hour period. We use the different day period to tell its increase or decrease in volatility, and that means its ability to move to our predetermined targets. And it shows us where great trades exist, where high reward is, and where the marginal trade is on a pair. All right. So the ATR can dramatically increase your understanding of what the market is trying to do. It's the big boys agenda, and also show you where to add when a pullback is done. And we are now resuming to the target, or even more important, if there is not enough of the ATR left to have a high reward, low risk trade. So here's an opportunity for you. You can go try this app for 7 days free. There is the address right there, and also we'd like to welcome you to our live room. We use it every single day. You can watch us use it. It's free for 10 days. Come on over and learn some things, and hey, you might even make some pips in the process. So I hope that helps you. The ATR, in my opinion, is indispensable in trading the Forex market. So you can join us at proacttraders.com. Thanks for watching. Hope it helped you. We'll talk with you later.